Welcome back to For Finance. In this video, I'll be breaking down how much you need to make in order to afford a 2023 Jaguar F-PACE. You should really consider following one of these rules in order to avoid making a huge mistake that'll end up setting you back for years to come, financially speaking. I've also got a link to a free auto quote where you can save up to about $600 a year on your own auto insurance in the description below, but more on that later. There are 4 options that I'll be going over today, and you can decide on which one suits you the best depending on how into cars you are. Some people just want something cheap, reliable, take them from point A to point B, no fuss, no frills, and some are willing to sacrifice quite a lot more in order to get the car that they really want. Stick around to the end of the video, find out what method would be best for your own situation and your preferences. This is 4-Wheel Finance, a channel dedicated to helping you make smart financial decisions. Before I dive into the first rule, these videos take quite a lot of time and effort to make, so please give it a like, subscribe, and comment down below what other vehicles you would like me to review or your opinion on these values. First rule I'll be going over is the 24-10 rule, and this states that you should put at least 20% down, you shouldn't finance it for more than 4 years or 48 months, and the payment shouldn't be more than 10% of your monthly gross income. Since the 2023 Jaguar F-PACE has an MSRP of about $52,400, this would mean you'd need to put down $10,480. And with the average new vehicle interest rate of 3.86% in a 48-month term, this would bring your monthly payment to $943.89. Take note here that you're also paying about $3,300 in interest. Bankrate states that the average monthly insurance cost is $148 a month. This varies a ton from person to person, your age, your gender, where you live in the country, and the kind of car that you have. So give a look at that smart financial link I've got down there in the description. See if you can save a little bit of money on your own insurance. It takes like 20-30 seconds to fill out, and it's completely free. This brings your monthly total to $1,091.89. Going back to that 24-10 rule, given your monthly cost is $1,091, you would need a monthly gross income of $10,918 or an annual gross income of about $130K to comfortably afford something like this. I really encourage you to take a look at the opportunity cost here. If you were to buy a cheaper $10,000 car and put what would be your car payment of $943.89 in the market instead, over the course of 5 years with a conservative 6% rate of return, this returned to about $65,906, gaining about $9,000 here in interest. Take a look at those Acorns and M1 Finance links I've got down there in the description below. It's super easy to get started investing, and I highly encourage you to get started as early as you can. Even a small amount of money can turn into something pretty special over a long period of time. And again, this is just for the first 5 years. If you were to continue this for 10 years, it would amount to about $154,000 and over $40,000 in interest. Again, just at a 6% rate of return. And for reference, the stock market averages around 10% return per year, so the 6% that I'm using here is pretty conservative. The next rule I'll be going over is my own. And for my rule, I think you should have at least a 6-month emergency fund, invest 15% of your monthly gross income into your 401k, and max out ideally a Roth IRA and your HSA, but I'll leave the HSA portion as optional. Yes, I know this seems like quite a lot of saving and investing, and it kind of is, but beyond that, I don't give you any monthly percentage rule that you have to stick to in terms of spending. And so it's up to you to decide if you want to spend more of your monthly income on a vehicle, or if you'd rather spend less, go out to eat more, on more vacations, etc. And the 6-month emergency fund just ensures that you're covered in the case that obviously an emergency happens. Especially if you got payments on a car or something like that, I think you should have a really beefy emergency fund, especially if you're in an industry such as sales or a commission-based industry where your income on a month-to-month basis isn't always as stable as other jobs. And the investment portion just gives you a little bit of financial security later in life when you'll need it the most. The average American lives to about 78 years old, and so there's people arguing with me saying, hey, nothing's guaranteed. I want to spend my money now because it might not be here tomorrow. And to that I say, statistically speaking, you're going to live to at least like 78 years old, and so you're going to be thanking yourself once you get to that age if you start investing now. Next rule I'll be going over is the Dave Ramsey rule, and he thinks you should have at least a 3 to 6 month emergency fund. The vehicle shouldn't be more than 50% of your annual gross income, and you should buy it in cash. Given that the 2023 Jaguar F-PACE starts at $52,400, your annual gross income would need to be a minimum of $104,800. Ideally, it's nicest to buy a vehicle in cash, as you would avoid having to pay that $3,300 in interest, and your insurance would be a little bit lower. But obviously, not everybody's got $52,000 in cash. Probably not many at all. Pretty rare. But obviously, not everybody's got $52,000 in cash. It's probably pretty rare for the majority. And there's a chance that that money could actually make a little bit more if it was in the market instead and you just finance this car. Final rule we'll be going over today is the 1/10 rule, which was developed by Financial Samurai. Personally, one that I think the majority of people trying to build their wealth should consider. It really doesn't allow you to purchase a new vehicle, but it's set up to help you spend responsibly, which in turn reduces your financial car ownership stress and increases your net worth over time. This rule is pretty straightforward. It states that you shouldn't spend more than 10% of your monthly gross income on a vehicle. It can be new or old, but it's obviously going to be old for just about everybody. And you must own that vehicle for at least 5 years, but ideally more. And the theory behind this here is to help minimize your financial stress. It frees up some money to invest in assets or opportunities that may come your way. It's much more stressful and difficult making important life decisions when you've got monthly payments each and every month, something that's hanging over your head. Once again, this is 4 Wheel Finance. If you've got any questions regarding car buying or how much of a car that you can afford, please leave them down there in the comments below. And don't forget to give a look at that Smart Financial link. It's a completely free auto quote. See if you can save a little bit of money on your monthly car insurance.